All right, so let's get started. Quick, Age, I'm glad you're here. Our disclaimer, of course, I'm gonna leave it up here for people to glance at it. Of course, we're not investment advisors. We're not registered, and these are for educational purposes only. People have to understand the risk that is inherent with options, and we're gonna talk about that a lot as well. So a quick outline of what we want to do today. So I made the slides in a way that if you're kind of a beginner or have no idea about options, you're not going to get lost today. So don't worry. We're going to do very basic understanding of option. We're going to talk about the noise and the signal. So a lot of strategies, a straddle, strangle, butterfly, this, that. I'm going to tell you as a day trader what you need to focus on, what is noise and what is signal. We're going to talk about single leg strategies and multi-leg strategies. And the day trading strategy that we're going to focus today is the ORBs, because I assume that's the majority of what everyone's focusing on. And I try to keep the presentation really interactive and constantly ask questions. And then hopefully by the end, we're going to have 15 to 20 minutes to answer some questions, as well as kind of going back and forth, maybe look at some charts together and see the potential and some good trade opportunities. So again, note that I said part one, and the reason I said part one is because we're only focusing on ORBs, but hopefully today will give you the foundation to apply the knowledge you learned today to everyday trading strategy. So a quick background for our newer members, people who don't know me, maybe. So my background is in finance and financial engineering. Been in the financial market since 2017. Been actively trading since 2020, with BBT since 2021. I worked at a family office and a long only wealth management fund prior to this. And if you got questions, you can always email me at rd@bearbletraders.com. Always happy when I receive emails from our members. So over the past year, I've been going to quite a few meetups. And one of the key things that I've noticed during these meetups is everyone come up to me and they're like, "Oh, Artie, we love your material. We love," yeah, Ryan, exactly, that's you. We love we love the stuff you talk about, but we have no idea what you're saying." That has kind of been the common theme in every meetup that I've been going. And that made me wonder, why is it? Am I complicating things? Am I making things too complicated? And it's totally not you guys' fault. The fact of the matter is, well, options are complicated. You know, there is probability distribution and implied volatility and the skew and the term structure and this and that. It becomes challenging. It becomes overwhelming. But the fact of the matter is, if you want to focus on day trading, you could scratch all this stuff. You don't need a lot of this stuff. So these outcome distribution or implied volatility or the skew becomes really important if you want to hold for a week, for 2 weeks, majority of the stuff that I do. But if you're scalping, if you're day trading similar to what Andrew's doing, these all become that noise and not the signal. So I kind of focused on, looking back at all these meetups, and the feedback I got from you guys is I need to simple it down. And that's exactly what we're going to do today. We're going to keep it extremely simple. We're going to focus on price action, and we're going to talk about how we can use options to take advantage of some of the capabilities that option give us, like capital efficiency, that the stocks just don't. And this is basically the quote I want to start with. Any fool can make things more complex. It takes a touch of a genius to move in the opposite direction. Does anybody know who says this? Who's Warren Buffett? No, I'm just joking. No. Einstein said that, Albert Einstein, right? So it's a very, very well-known quote. And I live by it. Like investing, trading can be really complicated, but the genius is to keeping it really simple. So again, going back to this chart, it can get complicated. What is the probability distribution? What is the implied volatility? What is the skew? We don't care. If you're a day trader, don't worry about all of this stuff. This is mostly if you're doing weekly options, more longer term positions. We want to focus on the simples today. We want to keep it simple. That's what we want to do today. So, majority of the times I say one of the reasons I personally love options is because they're three-dimensional. So in a stock, you can only go long or you can go short. You can bet that the stock's going to go up or you can bet that the stock's going to go down. But in the option market, you have another dimension, and that's the speed. You can bet on the volatility. But if you're day trading and if you're scalping, similar to what Andrew is doing, you can completely forget about this. Don't worry about this at all. So just think of options as another tool to give you a little bit more advantage in trading. So again, going back to the previous slide, a lot of these tools that you see me use on a daily in the chat room is because of that speed component of options, the volatility component. So don't worry about it. We're not going to do any of these things today. We're going to keep it simple. So let's start with a really basic, okay? Let's start with just a basic diagram, a payout diagram for option tradings, and we're going to get into some strategies. But buying a call, this is what your outcome looks like. You buy at a certain price, at a certain strike. You pay a premium for that strike. So all the way until we move against that premium, that's kind of your break-even point. And if the stock continues to go higher, you make more and more and more and more and more and more money. This over here is kind of your P&L. Buying a put, similar story. You pay a premium. If the stock goes down, again, this is price. If the stock goes down, you make more and more and more and more and more and more money. What's the maximum you can make? If the stock goes to zero, that's the maximum you can make, right? Now, selling a call is kind of bearish. So if the stock goes down, you get to keep all the premium you collected, and your maximum is capped if the stock doesn't move. Selling a put is the exact opposite. If the stock goes up, you get to keep all the premium that you sold and you collected, and basically the contracts expire worthless. You keep all the premium. So you probably have heard Brian saying, I sold some puts or I sold some calls. So let's do a quick pop quiz, because as you said, I'll try to keep this webinar as interactive as possible. If I'm bullish on a stock, what are my options? What should I do? Based on these four things that you see on the chart. Buy calls, sell puts, buy calls, sell puts. Exactly. We got it. That's it. Let's keep it simple. Don't worry about a straddle or a vertical or a diagonal spread. Back to the basic. Today is all about the basic. You're bullish. Okay, you're a bull. You can buy a call or you can sell a put. What about if you're bearish? Yeah, you got it. Sell a call and buy a put. It's that simple, really. It's really that simple. So you can apply this terminology that you kind of picked up today, and really add it, theoretically, really add it to any strategy that you have, whether it's the R4, whether it's the S4 to R4 reversal, or ORB, or the 920, and we can really do a webinar for each one of these strategies, and I can showcase you the power of them with options. But the truth of the matter is, if you understand this slide well enough, this is 90% of option trading. Yeah, so JS Notes, that's a programming language. I like the username. So he's saying something really interesting, saying, hey, you got some unlimited losses over here, and it seems like there's some unlimited losses over here. What's going on here? Yes, every time you're selling an option, it's a little bit more risky. Margins get involved. A little later in the presentation, we'll get into those in more details as well. But again, remember, you're day trading, right? So theoretically, by the end of the day, you should close this position. So this selling put, the payout that you see is if you sell a put, you get assigned, and then the stock goes to zero. But how likely is that throughout the day? Very unlikely, right? Unless you're holding some really terrible companies. Does this diagram, this 4 diagram, make sense? Okay, amazing. So again, buying calls, you want to be slightly in the money, and we'll talk about it why. And if you're even more bullish, you can sell some puts to cover the cost for your calls. Okay, so if you're bullish, you want to buy calls. Again, everybody answered here. Almost everybody answered. If you're bullish, you should buy call and sell puts. So if you want to bet on an up direction, you want to buy some calls. You want them to be slightly in the money. Again, we'll talk about this why. And if you're really, really bullish, you can sell some puts at some levels, key levels. We'll talk about it, how it would mean in ORB to cover the cost for your calls. Okay. Same story. If you're bearish, you want to buy puts. Again, the puts, you want them to be slightly in the money. If you're even more bearish, you can sell some calls to cover the cost for buying your puts. So they're going hand in hand. Because remember, let's go back here. When you're selling options, you're getting paid, right? It's like short selling. When you short sell a stock, you get cash into your account. The cash comes into your account, right? So it's the same story with options. When you're selling options, whether it's a call or a put, money comes into your account, and then you can use that money and pay for some premium. So they become extra bullish or extra bearish. Yes, JS, explain in the money for us newbies. Yeah, absolutely. I'm so glad that you asked. So let's go ahead to really quickly. Let's go ahead to an option chain. So pick a stock, any stock you like. Let's go Netflix as an example. Let's forget about the after hours fiasco. But whenever you open an option chain, this is what you see. You got I'll spend a couple of minutes really quickly on this, but you got your right-hand side, these areas, these are in the money puts. As you can see, they're a little shaded in blue, and these are in the money calls, right? So a call, you're betting that the stock will go up. So if Netflix is already at 230, if you buy a $210 call, this contract is already in the money, right? Because it's already above the $210. If Netflix is like, let's say after hours at 230 and you buy a 240 puts, you're betting that Netflix will be below 240. This put contract is already in the money. So that's all it means. And that's one of the reasons we lose a lot of people to options, is because they look at this option chain and it's complicated, because the stock is just a buy and sell. But with options, you can buy this contract, you can buy this contract, you can buy this contract. There's so many options. And that's how it becomes a little complicated for people. So hopefully that makes sense. So let's go ahead to like the opening range breakouts and breakdowns, right? So very similar. I don't want to spend a lot of time on this slide, but the key areas of how you recognize the ORB is the same. You know, if you want to short it, the weaker stock. If you want to go long, a strong stock. Ideally, it's trading above VWAP. Andrew has done many webinars on this. You know, Peter has done, Jared has done. If you go to our education center, there's tons of stuff. So I don't want to spend a lot of time on ORBs per se, but I want to spend some time on how you could do them with options and why options are so powerful. And yes, Paula, we'll talk about which contract to use to have a higher probability of making money. So let's pick Goldman as an example. And this is an interesting example because for those of you who were in the chat this morning, you know I got a stock in Goldman because I sold some calls. But I want to show you those contracts, and I tell you if I would have bought those contracts instead of selling them, how much money I would have made. And I want to kind of show you how powerful it is. But you know, in a case of the ORB, you know, very similar, classic. Again, nothing is changing here just because you're trading with options. Nothing is changing. You break the opening range, you go long, you got your exit maybe below VWAP if you get a close below VWAP. And, you know, for whatever R you're risking, depending on how you're doing your risk management, if there's a major level, key level, you can have it, your profit taken at that key level, or, you know, do a 3R, you know, 1 to 3 or 1 to 2 risk to reward. But you get a scenario like this. You break out of the opening range. You buy some contract. Again, now the question comes in. Paula is asking, what type of contract do I buy? There's so many when I look at the option chain. You want to be slightly in the money. Okay. Again, your exit strategy, Paula, we call them kind of the 0.75. 0.70 delta. You want to be using the 0.75 to 0.70 delta. That's kind of the deltas that you want to aim for. Again, that all delta means is kind of the probability of that option contract ending in the money. So, you know, a 0.70 is still giving you that movement in delta. I see there's a lot of questions coming about that, so I'm going to spend some time, but let me go through this slide and then I'll go to the option chain and we'll get there. So again, stock breaks out and then you kind of see this is kind of an all-day rally for the stocks. What if you're very, very bullish, right? So what if you're extremely bullish and you think, hey, the market has gapped up 2%. I want to be even more bullish. You can look at the candlestick and sell some premium, sell some puts at the open of the candlestick or the low of the candlestick, the opening candlestick. So you're selling some puts, you're gaining some money with selling puts, and then you're using the money that you earn to fund some of that cost of call, and then you let the position ride. So let's actually go ahead and look at this, and then I'll go to the option chain and I'll explain why the 75 delta and all that stuff. Again, granted, remember I was short Goldman because this was an after earning play that I did. So I sold some calls, but you could just reverse it. I want to show you the power of it. So 6 contracts at 144. So right at the open at 144. Today, those six contracts, they closed. Again, for those of you who were in the chat room, you know that I hedged my position by buying the Goldman Sachs, by buying the underlyings. But I want to show you, this turned out really amazing. So 6 contracts, bottom at 144. At the close today, they were trading at 766. So how much money did you put forward? $864, right? 600 times 144, right? Because each contract is 100, so 600 times 144. You put up $864. What is your potential payout here? About $3,000, right? Now they're trading at 766. You put 864, you made $3,000. If you wanted to do the same thing with stock, like again, for hedging purposes, I bought 300 of Goldman Sachs. You had to put up $92,000 for buying power. So you see why options become, they get this bad rep of gambling, or there's pure speculation, because they're very powerful. They're like stocks on steroids. There tons of leverage in them, inherently in them. So yeah, if you tell someone, hey, I put up $800 and I made almost $4,000 today, they're gonna tell you, hey, you're gambling. But the fact of the matter is, you're just using options. They're just more capital efficient. So again, today, so as part, this is again, this as part of my, remember I said, if you wanted to be more aggressive, you could have even sold some puts to fund some of the call contracts that you would have bought. So in my case, again, this was part of a different trade, but I sold some puts, the 297.50 puts. So these are exactly at the opening candle, at the low of the opening candle. So around there, around this area, I sold some puts. How much did I get paid for these puts? About $1. So think of it this way. You get paid $1 and you use that $1 and you go ahead and buy these 312 calls. So theoretically, these calls could only cost you 44 cents or $44 per contract. So you bring down your initial buying power by almost 70%. So very, very powerful, very, very capital efficient. So think of it this way: when you put the put and the call next to one another, this is kind of your payout opportunity. You sell the put, the stock is going your way, so the puts is losing value. So you're making money over here, and then you bought the call, and you're making tons of money over here as well. Again, this turned out, this was pure luck today that I had this trade on the Goldman. Again, on the other side, this was mostly hedging, but to kind of show you the power of the option. The risk management, again, don't overcomplicate it. Just because it's option, the risk management is exactly the same as the stocks. Whatever your risk management or your stop is, you have that. If it closed below the VWAP, if however you want to define your R's, it's the exact same thing. You're just using a different instrument. So Chris R is asking, how do you protect yourself? Again, similar to stocks, right? You want to be able to, if the stock's not moving your way, you want to be able to, exit as quickly as possible if kind of the thesis change. Same risk management. One of the reasons that I said 0.70 delta is because the 0.70 delta is a slightly in the money, right? So let's go ahead and take a look at an option chain. And this is, I think, is important. If you go deep in the money in the option chain, what is the delta of these contracts? If you go deep in the money, Gemini is saying what? 1. Exactly. What does that mean? What does that 1 mean? It means for every $1 that the stock moves, the option price also moves $1. So at this point, if you go ahead and buy deep in the money options, you're not really, yeah, exactly. Or Nathan, another way of interpreting it is that there is 100% probability that this option is going to finish in the money. So what is the side effect of going so in the money? What's kind of the problem with that? If you want to trade just direction, if you're just a scalping, what is the problem with that? Liquidity could be one of them. Another reason is, look over here, you got to put $5,000 per contract, but over here, you only got to put 1,400. So as spreads get wider, exactly, Nathan, and it's more expensive. right? So there is a sweet spot for these type of trades, and that's the 0.70 delta. But again, I want to prove it to you. What if you go way out of the money call and you go ahead and buy the 255? What happens here? What's the problem over here? No movement. Exactly. You got it absolutely right. So if you go so out of the money, even if the stock is moving and is making that movement that you want, the option pricing is not changing as much, right? And that's because there's delta, which is the rate of change that the option price changes with how much the underlying moves. But there's also gamma, right? And that's how much delta changes. That's how much the delta changes, like the speed of the change in the delta. So there's another derivative to that too. Again, my goal was to keep it simple today. I don't want to complicate things. But if you go so far out of the money, these become kind of the units. So for every dollar that the underlying is changing, delta is no longer changing. These are not gaining as much value. So we kind of justified that there is a big problem if we go way out of the money, and we also justified there is a big problem if we go way in the money, right? We say way in the money is not as liquid, it's more expensive, we might as well just buy the underlying. And if we go way out of the money, yes, they're cheaper, but again, there's a spread, you got liquidity issue, as well as the stock might move by $2-3, but these contracts are not moving by $2-3. Right? The rate of change of delta is a lot slower. So the sweet spot, Paula, to answer your question for these type of trades is, 0.65 to 0.75 delta. So around these areas, if you're betting right now on a scalp, on an all-day move, on a kind of an opening range trade for, Netflix as an example, your best bet is somewhere around here. So this, if I had to bet, I would bet this is kind of probably like a 60 to 65 delta, right? 63 delta. You do this enough and you're trading enough, you can know exactly what is the delta of each contract without even having to click on it. Does this make sense? JS is asking a great question. How do we find the delta on the option chain? You click on your option chain. When the stock is right at the money, JS, remember, think of delta as the probability of an option finishing in the money. When the stock is right at the money, so it's right here, over here, right over here. Okay, what is the delta here? What is the probability of that option finishing in the money? You can think of it as a coin toss. What is a coin toss probability? It's a 50-50%, right? At any moment, a stock might go up, might go down. So you don't even worry about DAS doesn't have delta. At the money calls and puts, their delta is 50. It's slightly in the money, or now the deeper you go in the money, the closer you get to 1. And then the same story over here. The deeper you go in the money puts, the closer you go to -1. So don't even worry about, I don't have this tool, or I can't make that probability distribution. Remember, what's the theme of today's presentation? Keeping it simple. So don't worry about Greeks and all that stuff. You just want to be slightly in the money in your option chain, right around here. This is your key area. You want to short, you want to be somewhere around here. I'm sure you can, Grog. Grog is asking, can I hotkey for 70 delta? I'm pretty sure there has to be. Remember, the delta is constantly changing, so you probably can do that. And you might get filled at a contract that has the 70 delta, but I haven't played around with it. So probably someone who is more kind of hotkey savvy is your guy to ask. Yeah, so open interest, we'll get to that, Ryan. So let's go back to the slides again and look at another example also from today. IBM today, after earning, great, opening range breakdown, right? Again, near the VWAP, you get kind of this doji kind of showing that, okay, the buyers are exhausted over here. The stock sells off, right? You enter right after the second, somewhere around here, you enter your trade, and then your stop is if we close above the VWAP, and then the same story again. You're looking at the IBM, the chart. You're not really caring about what's going on with the option. But this is how your P&L would have looked like if you were looking at the option for IBM. So you buy the puts. What type of put do you buy? Where do you pick it in the option chain? What location? It's slightly in the money. Yeah, negative 0.70 delta in this case, right? It's slightly in the money. That's exactly what you want. The same story with the calls. It's just the other way around. And then you kind of get this $1 move out of the contract, except it didn't cost you $100. It didn't cost you like a $10,000 investment. It only cost you $100 to get that $1 move in terms of trading. I wanted to show. So a very key question comes in here, and a lot of people argue, hey, why don't we just use, rather than looking at the IBM chart, why don't we just look at the contract and just trade this chart? What's the problem with this? Why not just forget about the IBM chart and look at this July 2020 131 put contract and just trade this as an opening range breakup? What is the problem with that? You could theoretically do it. The problem is this chart is derived by that chart. This is a derivative chart, right? So you've heard a lot of like great traders saying you can't really use technical analysis on TQQ or TNA, right? Like because those are derivative charts. What does that mean? It means that chart is derived by another chart, right? These are it's because of the options, their pricing is derived by the underlying. So there are people that teach others like, hey, just look at this option and trade this as an opening range breakup, and it's kind of true, but I would argue it's not the right way of doing it. Okay, because this is a derivative chart. You don't want to do it. The pros, those guys that are are doing this, they look at the underlying chart, and this is dictating on what's happening with the stock. This is secondary. Again, if you remember from our closing bell show, right? Like Brian Shannon was on, and he was against using kind of the technical analysis on TQQs or these type of derivative style, right? And he's written a book on technical analysis. So let's answer a little bit more questions and then see what's going on. Should we stick with high open interest? Yeah, Ryan. So we'll get to it at the end of the presentation, but overall, the spreads get really wide in the option market. So you can't trade options for every security. You want it to be liquid. Even like look at this IBM, right? Like even the IBM, this 131 put. So let me see if I can bring it up in the option chain. Let's go ahead and take a look at this guy, for example. Actually, let me close this. Let me turn this off. Let's go ahead. Let's go to 1 minute. I mean, look at these, right? You see how like choppy and not really clear it gets, right? It's good in the morning. You kind of see some decent price action over here, but after that the spread just gets too wide, right? So again, IBM is a great example of a stock that you can't really trade it much with options. There's not a lot of volume, not a lot of excitement. The only reason I picked it for today is because it had earnings. But compare this with an option chart for Tesla, and it's a whole different story, different animal completely. I mean, let's go ahead. Today was a strong day, so let's pick a call option. You see, like look at the charting. It just looks so much different. So volume, option, open interest, all of this stuff play a role into picking your stock. So let me answer a couple more questions, and then we'll get into the rest of the presentation. The fee structure for IB, I believe, is $1 per contract. It's a buck, about a buck. Do you think it is necessary to get practice with trading stock first? Yeah, definitely, Michael. I think you, again, because you mostly, option is just a tool. You're still trading the stock. You're just using a more capital efficient tool. So definitely, you want to learn. You want to learn with stock. That's my honest answer. Yeah, no, Andrew, no analysis on the wicks, right? Because we're not really worried about what's going to happen with volatility. We're just trading the delta here, right? We remember in the first slide I said options are amazing because there's 3 dimension, right? There's the long, there's the short, and there's the speed. But we don't have to do anything with the speed here. All we're caring about is the direction. So we're mostly solely betting on the delta. New mental stop. Okay, so let's continue, and then we'll try to answer all the questions. Again, my goal is by the end of this, Ranjit is saying he has a question in the question tab, so let me just answer this before I go ahead. I don't want to be rude. Is it possible to show simulated trading? Simulated trading, we could, yeah. I have to just log into my simulated account, and then we can definitely take a look at that. But again, we focus today on opening range breakouts and breakdowns, right? But truth of the matter is, my goal is by the end of today, you really realize you get that fear of options out of your system. That you can really trade these depending on whatever strategy there is. So here's another example. Again, this is an example of a trade that I did a few months back, earlier in the year. Tesla at S4 below VWAP, tested it a couple of times. It seems like it's not breaking S4. You know, you could have your stop below S4, and then kind of see if you can make that red to green move, right? Again, remember it was green. So this is kind of this is a S4 to R4 reversal trade. You know, Tor, one of our beloved traders, make this trade a lot, right? So let's take a look at this and see how we traded this. So again, this is from my trade log. You know, market open, I bought some Tesla calls, got cold fitted, sold them. So bought, sold. And then right at 6:54, which is about, what is it, about like 9:54 our time, the market time, I bought it. And then right when we made that red to green, 4 minutes later, so again, this is completely day trading. 4 minutes later, sold these contracts for a decent profit. So take a look at the pricing over here. This is also important. You bought the contract at 38.47, took your first partial at 41.07, so that's a $300 gain in just a couple of minutes, and you exited the remaining at 42.90. So that contract that you bought, remember, you're trading the contract, right? I get these questions a lot. They're like, oh, does that mean Tesla has to go up $38 for me to break even? No. You're day trading. You're trading the contract. You're going to sell that contract more expensive to the next person. That same contract was sold for about $5 more a few minutes later, right, at 6.57. So again, if I want to take a look at this in the chart, I enter one time, got it stopped out, entered again right around here, and then closed right around 10 o'clock. So when we got this candlestick, I exited this strategy for a red to green move. Again, this has nothing to do with opening range breakdown, but again, that's my whole point, is once you learn these basics, you can really apply them to any day trading strategy. So I had 3 contracts, okay? I paid $37.50 for them. So how much money did I put? $11,250. I made 1.8, right? So I made 1,800 on this trade in a few minutes. That's a 16% return, right? You divide this number by this number, 16% return on your trade. If you wanted to get the same amount of money, if you wanted to make 1,800 using Tesla, Tesla, again, granted, this was when Tesla was $1,000, you should have put a 300,000 buying power. So who remembers, it was Megan recently, right, that she said she wished she had a bigger account so she could trade Tesla better. And I said, oh, Megan, you have to get into options. There you go. There you have it. This is the power of options, right? You're getting the same amount of results with 1/100th of the buying power that you need to put up. So I see a lot of you guys are helping each other out as well in the chat and answering some of the questions. I really appreciate that. That's amazing. So key things to remember, and kind of try to bring this to kind of wrapping it up together. You want liquid options. You want to pay attention to bid and ask. You want to see how the spread is. You don't want the spread to get too wide. You want some kind of a catalyst. You want it to be after earnings, stock is gapped up, some kind of a catalyst. You want it to be in there so that there's more volume in the option market. Remember, time works against you here, especially if you're buying options. So the worst thing you want is, let me go ahead. The worst thing you want here is the stock not doing anything. So, it's just hovering around something all day, not doing anything. When you buy premium, you're buying volatility. You're buying that delta. You're paying money for, think of it as a really fast car. Think of options as really fast car. When you rent a fast car, you want to speed up with it. You want these type of move. If you want to go on a downside, you want massive, large candlesticks on the downside. So speed is really important. So again, why did I close some of my positions here? So I bought initially and then I sold and then I bought back again because I wasn't getting that speed. I was chopping around. So speed is really important. So time is working against you. If you buy options, if you're buying a call, if you're buying a put, you want that as speed. You want a nice big move. So have that in mind, because if the stock is not doing anything, your option is losing value. So speed matters. And if you're selling an option, so again, remember I said you could have sold some of those Goldman Sachs put and then use it to finance buying calls, then you require a little bigger accounts. You require some margin. And of course, risk management is key. So I don't want to sit here and give the notion of you can put $11,000 and make 1,800 every day, because the other way is also true. You could lose a lot of money that quickly as well. So a trade could go the opposite way as well. So I don't want to sit here and say, hey, this is the key to financial freedom and you're going to make this much money. You have to understand risk management is very, very important. Same risk management you have with the stock, you have to have even more kind of tighter risk management with options. So that's kind of the end of my presentation. So let's go ahead and spend some time with the questions. I'm going to go into the questions and then try to answer as many as possible. I'll go to the question tab first, and then I'll move to the chat. So Spencer is asking, with the buying power being so much more efficient, what are the downsides to options? Why ever trade shares if options are so much efficient? So, well, Spencer, that you hit it right on the head. That's amazing. Well, remember, in finance, in markets, return is a double-edged sword. The more return you're making, the more you're risking, right? So you could put 11,000 and make 1,000, but remember, if the stock goes $1-2 away, you could theoretically lose 1,000 or 2,000. So it's the same story, right? So yes, it is more it is more efficient, but again, return is a double-edged sword. The more you make, the more you're risking, which means potentially in a worst case scenario, the more you could lose, right? So that's why you see these Robinhood millionaires that had really little money, and then they all shared their screenshot making a lot of money in 2020, but then they gave it all back, right? Because they didn't have that risk management in place. They were just using leverage. So leverage is a double-edged sword. You're using leverage with options. I look at the underlying Marcel for my stops, and then I exit my strategies. You could use limit orders as well. Do you typically buy options, call, or I put options at the money? Yeah. So if I'm trading on a range, like on a trend days like this, like these type of strategies we talked about today, I want to be slightly in the money. And I buy the options, but majority of the times when you're in the chat room, you've seen I'm mostly doing weekly options. But today's webinar is solely focused on day trading these instruments. Oh, okay. JS is asking a great question. This is on your trade log. When you first bought and then you sold, you got cold fit. In this case, would you lose all your money? Okay, that's a great question. So let's go ahead and go back. When over here, when I didn't see that conviction and I sold, okay, because again, remember, I'm looking for a speed. I sold. You're not gonna lose all your money, right? You're obviously are gonna lose the commission, right? Because in and out of the trade, that's the expense you're paying, okay? But if you're buying a slightly in the money call, if the stock goes down and let's say a couple of dollars and that option contracts become at the money, your slightly in the money 0.60, 0.70 delta becomes 0.50 delta. So on that contract, you're probably going to lose about 20%. So in this case, I exited, I think, with a teeny tiny profit. So I bought at 37.55 and then I sold at 38.90. But again, this is like very small gain, right? But then I bought back again at 38.47, and then we got this big move. But there's no way you'll lose all your money. JS is only if you don't sell and the stock goes against you and that option contract expire worthless. So let's say you buy a contract, the expiry is on Friday. You think Tesla is going to go up, but Tesla goes down, and you don't sell your contract that day, and you keep it in a hope of tomorrow it's going to bounce, and then tomorrow it's going to bounce, and then you go to Friday, and that option contract is so out of the money that it's not worth anything anymore. So that's the only way you will lose all your money, which, by the way, is one of the benefits, because when you buy 4 or 5 contracts, you know that's the maximum you're going to lose in the worst case scenario. Ranjit is saying, if I buy the call, it went the opposite way already, I lose the premium. You don't lose all the premium, right? Because remember, it's slightly in the money, the contract that you've bought. But yes, you're going to lose. The same thing with the stocks, right? If the stock goes down, you're gonna lose money. But your losses are also magnified here with options. Because you're using leverage. Remember, return is a double-edged sword. It's great on the good times, but if it's bad, then it's bad also on the bad time. Again, I don't want people after this presentation to think, man, why are we even trading stocks? Options are amazing. Yeah, return comes with risk. Marcel is saying something really interesting. It says, thoughts on making intentional YOLO Lotto option plays part of your strategy. That is, a lot of people do that. And a lot of people, Marcel, were making a lot of money during 2020 because we were having so many trend days. So basically what Marcel is saying is, hey, you had a good day trading day. You made $1,000. Go to the option chain on, let's keep talking about Tesla. Let's say you started, okay, and you shorted Tesla and you covered somewhere around here, and now you're done with your day. You could go ahead and buy way out of the money call for really cheap, like really, really cheap, like 71 bucks, right? Or let's say, I don't know, like 290, like these 820 calls, like way out of the money. You could go ahead and buy it, a portion of your profit, in a case that all of a sudden Tesla rallies, you end up making a lot of money. You could do that, but there's no strategy, there's no trade book. I know traders that actually do that, but there's no strategy, there's no trade book. But if it turns out, if you are right, if that option that is so out of the money all of a sudden becomes at the money or in the money, the gains you're gonna make 10x, 15x. You're gonna make a lot more. So JS is saying, so it's not all or nothing. It's not all or nothing, because remember, you're trading the contract. So if the stock goes against you, you're gonna lose some money. If it goes so against you and you don't get stop out, you're probably gonna lose all your money. If you keep hanging on to that option contract, it's gonna expire worthless, and you lose all your money, all the money that you put up. But you're not gonna lose more than you put up. So if you buy a 755 option call on Tesla, you're putting up $1,645. You're not going to lose more than this. This is the worst case scenario. Yeah, you can use the stop losses and limit orders on options. They're simple contracts, right? They're exactly like that. You can make different type of orders here. You have the same mantra, same montage as you have for stocks, identical. Yes, Ravi, let's go ahead. Where is this? Yeah, so these are buying puts and selling puts. These are the last two. Hope if you have any specific questions, Ravi, about them, let me know. But again, this is buying puts. So when you're buying puts, you're bearish. So for every dollar that the price goes down, you're making money dollar for dollar for dollar for dollar. The maximum you can make is if the stock goes to zero. This is selling puts. So it's a bullish strategies. So you're selling put if the stock goes up, if it continues to go up. So this is price on the x-axis. If the price goes up, so from $10 goes to $12, $13, the put that you've sold lose all of its value and expire worthless, and you get to keep all the premium. If all of a sudden it goes down, you're wrong. You get to participate in the losses dollar for dollar for dollar for dollar. So Ranjit, the option market closes after hours, but I mean it's quite very similar to what you want to do is, you go ahead to your underlying, in this case Tesla, you go to your option chain and you want to bet that you want to make a bullish bet. You select a slightly in the money call. You select how many contracts you want to do. Like, again, you can automate all this, by the way. You want to say minimum 4 contracts, minimum 5 contracts, and then you can go ahead and sell. If you want to get filled right away, right? You want to buy at the ask and you get filled right away. And then you can go ahead and trade it. You submit your order and that's it. So obviously it's telling me, hey, the market is closed. Your order will not be placed. Okay. And all that stuff. And then your order comes up here. And then you know what you want to do. Let's answer a few more questions. Thoughts on IBKR options? Yeah, that's what I'm using. I really like it, Marcel. Does it matter whether the contract expires weekly, monthly? Do you look for the criteria for day trading? JS, that's a great question. You always want to pick the closest expiry. So if you have an option of 0 days to expiry, then you want to pick that. Because remember, you're not really betting on what's going to happen to the volatility and the time decay. You're just betting on a direction here. So either 0 days to expiry, so expiry same day. So in a case of SPY, I think now you have everyday expiry. I know the indexes have. So now you got July 20th, July 22nd, July 25th. And in case of more liquid stocks, you have weekly options. So you got every Friday. And some stocks that are less liquid, like for example AI, you have monthly options. So August, September, October. So and you even have quarterly options. So what you want to do is you want to pick the closest expiry. But remember, if the stock doesn't have a weekly option, like every Friday expiry, it's probably not a good stock to day trade with options. Yeah, Ranji. So this is a real account, but the interactive broker will also give you a simulated account. You can play around, start playing around in the simulated account. So yeah, Nathan, thank you so much for answering a lot of the questions in the chat. I really appreciate it. Same with Caesar. Thank you guys so much. Chris, thank you. If there's no questions, we're about 6 minutes over time, so I'm gonna call it up. But shoot me an email. So let me bring up this slide. You got questions? There's things going on. Shoot me an email, okay? I'm always happy to help. Again, my goal is keep it as transparent as possible. Yes, you can make a lot of money, but there's risk involved, right? Every time there's return in the market, there's also risk. Understand these and shoot me an email. Definitely start in the sim, please. Simulator. You want to start there. No worries at all. Yeah, thank you so much. Thank you, Thomas. Thank you, Ranji. Thank you, Dan. Thanks, everyone. Have a good one, and hopefully the recording will be up by tomorrow. I know Carlos was doing us the favor of recording, and we'll see you guys tomorrow in the chat.